Chapter 8. This chapter is on short-term business decisions. So when you're making business decisions, in addition to looking at the financial implications, you also have to be aware of qualitative or non-financial factors that can play a role. You look at the impact on employees and relationships, on supplier relationships, environmental factors. If you decide to outsource, you have less control over delivery time and product quality. If you discount prices to certain groups of customers, is that going to alienate other customers? So all of these factors have to be considered. So good managers always consider not just the quantitative or the numbers, but they also consider these other qualitative factors when making business decisions. So in this chapter, there are 7 types of short-term decisions that businesses will make. So pricing, special orders, dropping a product department, the product mix, outsourcing, should you buy it ready-made or make it yourself, selling as is or processing further, and then transfer pricing as you transfer the product from one department or division to another. So pricing decisions, you have to consider what is your target profit, how much do you want to make, and how much will the customer pay? And are you in a market where you're a price taker or a price setter? So if you're a price taker, it means your product is not that unique. There's a pretty stiff competition, and the pricing really emphasizes, in this case, the target costing. Whereas if you're a price setter, it means your product is unique, you probably don't have a lot of competition, and the pricing approach emphasizes cost plus. If the company is a price taker, then you are really in a position where the market dictates you can only charge, say, $500 for this product because it's not that different from any other product, so you can't charge more. So your price is pretty much set, that this is what you can charge. So you have to then get your costs down to such a level where you can produce a realistic profit at that price level. On the flip side, if you're a price setter, then you can set the price. So what you do is you take the cost of your product and then add on how much income you want to earn, and then that will help you arrive at the price you want to charge for your product. We start off here with their cost. So here you have a company that has 250,000 units at 150 units. So the variable cost is $375,000. Their fixed cost is $325,000. So the total cost is $700,000. Then they want to make $100,000, so they have invested $1 million in this company, and they want to get a rate of return of 10%. So that's how they've come up with the $100,000. So what they want to get is a total of $800,000, and they sell 250,000 units. So to make that much money, they need to charge $3.20 for each unit. So you have to think about, if they're currently charging $3, they can probably, if they're a price setter, then they can charge the $3.20. But if they're in a very competitive environment, then they probably, can't increase the price. But now they know what the price is per unit on a cost-plus basis. So now if you're in a very competitive environment and you really can't change the market price, you can't change the price of what you want to charge for your product, so you have to then look at, okay, I can only charge $3 per unit, so 3 times the 250 units, 750,000, and I want to make 100,000. So your total cost for that product can only be 650,000. So you've got to look for ways to get that cost down so you can make your 100,000 by selling your product at $3. So that's target costing. If your actual cost is less than your target cost, fine, you don't need to do anything. But if your actual cost is greater than the target cost, the cost that the market will bear in a competitive environment, you either have to accept a lower profit. Maybe you can't make 100,000, maybe you can only make 50,000. Or you can look at ways to cut your fixed costs or find ways to cut your variable cost, or you can use some other strategies, changing your product mix or try to increase the uniqueness and value of the product, things like that. The next topic is short-term special decisions, and these are usually what we call a one-time special order. So when you're looking at a special order, you only have to look at relevant costs, revenues, and profits. So relevant are those that are changing. If a cost isn't changing, then you don't have to consider it. So when you're making those decisions, it's almost like a little bit of a decision tree at the beginning. So if a customer comes in and says, I want a special order of product A, and because I'm giving you a bulk order, you don't have to do the marketing or whatever, so you should be able to sell it to me for a lower price. First thing you have to look at is, do you have the capacity to produce an extra, say, 10,000 units of the product? If you don't, well, then you just reject it. But if you do, then what you have to do then is compare, is the revenue that is going to generate, will that be greater than the additional cost? Or will the cost be greater than the revenue? If the costs are greater than the revenue, again, you're going to reject. So you're only going to take on the special order, or even consider it, is it, first thing, you have to have capacity. The next thing is, will the revenues be greater than the costs that you've incurred? But then you've got to consider those qualitative factors. If you're going to give a really lower price to one particular customer, your other customers could get, very annoyed and possibly take their business elsewhere. So you might gain a one-time extra profit from this one-time order, but in the long term it could be to your disadvantage if your existing customers were, annoyed with you and decided to stop doing business with you. So an opportunity cost becomes part of the equation if the company is operating under full capacity. So say, for instance, back to our example where somebody comes along and says, I'm willing to pay you $3 per unit for 10,000 units. But to satisfy that special order, if you're already at full capacity, then you're going to have to give up making and selling some of your existing products to take on the special order. So then you have to consider what we call opportunity costs. So to take advantage of the special order, you're going to have to give up something, give up an opportunity. So here you have to look at what is the contribution margin that is lost from each regular sale that you can't fulfill in order to take on the special order. So then you would have to look at whether or not it's worthwhile to compare what you're giving up in order to get the extra revenue from the special order. So if what you're giving up is greater than what you're going to get from the special order, then you wouldn't take it on. But opportunity cost comes into play when you are at capacity and you're going to have to give up selling a certain number of existing units to take on the special order. Another decision that companies have to make is whether or not to drop a certain product or a department or a geographical area. So what you typically want to do is look at the costs, the fixed costs that will continue to exist even if you drop that particular product or market. If you're going to drop a particular product, are there any fixed costs that you could avoid? Or if you drop a certain product, even though it's not making a lot, maybe it will have a negative impact on other products you're selling. And then you also have to think about, if you're dropping a particular product or segment, then you'd have to consider, what are you going to do with that freed capacity? Can you make something else and use that to increase your overall profits? So looking at this particular example here, so say a company is making two types of air filters. So they have their regular air filters and their UV air cleaners. So when you look at the company in total, it's making like $105,000. But ideally, you would want to know how much you're making from the filters versus the cleaners. So when you break that down, you can see the difference here. So the air filters are profitable. They're actually more profitable. They're making really $124,074, whereas the UV cleaners, you're actually taking a loss on those 19,000. But that's looking at it at the high level. So by dropping the UV cleaners, you're not necessarily going to save all of that money, because some of that manufacturing cost is going to exist anyway. Some of the marketing might exist anyway, regardless if you're making one product or two products. When you look at the situation here, so the UV cleaners were 20,000 units. So if you just go back here to the previous slide, your cleaners, there's 20,000 units being sold. The revenue is 35,000. Contribution margin is 5,000. So what you want to consider here, if you're giving that up, what are you accomplishing? So if your total fixed cost, if they're going to continue to exist, so just go back here for a moment. So if the fixed manufacturing costs are still going to exist, regardless of whether or not you drop the UV cleaners, then that's not a relevant cost. The only cost in revenue you're going to consider when you're dropping a product is costs that are changing, either increasing or decreasing. If they're not changing, they're not relevant. So here you would have your decrease in revenue of 35,000, but you're decreasing your expenses by 30. So you're actually, by giving up the UV cleaners, you're only going to end up resulting in a decrease in your operating income because you're not saving on the fixed cost. So in this example here is you're looking at, can any of the direct fixed costs be avoided if the product is dropped? So for the UV cleaners, again, in this example, still 35,000, but by not making those UV cleaners, they can save some of the variable manufacturing costs. So 20,000 times 150, 30,000. And they had a supervisor whose role it was to supervise this product, so they can avoid that expense of 13,000 if they're no longer producing the product. So they're going to decrease the revenues and decrease the expenses by even more by giving this up. So here they would actually increase their operating income by 8,000. So again, it's all about considering what expenses you can avoid. So are the expenses that you can avoid greater or lesser than the decrease in revenue that you're going to give up? Product mix considerations. Typically, of course, a company makes and sells more than one product. So in this company, they're making shirts and jeans. So the selling price for shirts is $30. Their variable expenses is $12. So it's the contribution margin for shirts is $18. In comparison, the jeans, while they sell for $60 per unit, they cost a lot more to make, so their contribution margin is only $12. So if you're looking at it in terms of the dollars per unit, it's $18 for the shirts, $12 for the jeans. So, and then you look at it on a percentage basis, 60% contribution margin for the shirts and 20% for the jeans. So now what you want to do is you got to think about how much time it takes to make each product. Each unit of shirts is going to take 10 units per machine hour. So they can produce 10 shirts for each machine hours and 20 pairs of jeans for each machine hour. And we know what the contribution margin per unit is. We just calculated that, 18 and 12. Multiply that out. So the contribution margin on a machine hour basis, it's 180 for the shirts and 240 for the jeans, because it's important to consider the number of machine hours, because here in this example they have a maximum capacity of 2,000 machine hours. So that's the most they can produce. So the idea is you want to try to maximize the contribution margin per unit of constrained resources. So the constraint here is the number of machine hours. So if you're operating at full capacity, you could make 360 for the shirts and 480 for the jeans. So it's a little bit more involved than just looking at, if you just go back here and look at the contribution margin for the shirts and the jeans, you would say, oh, well, we should be selling more shirts. We're making more money on those. But the problem is the shirts, 10 units can be produced per machine hour, but you can produce 20 units of the jeans per machine hour. So the jeans are actually making more money for you. So another scenario here is the outsourcing. So should we continue to make all of our materials that we use to go into our product, or should we just buy some of those from another supplier? It's, make or buy is how we frame it, or outsourcing. So the idea here is you have to look at what are your costs that you're going to save by outsourcing versus the actual cost to outsource. And you have to consider, if you outsource, can you do something else then with that freed up capacity if you no longer need to use your manufacturing equipment for the full days, or something else you can make. Whether or not to outsource. So a company receives an offer to produce a product for 37 cents. So somebody's come to your company and say, I can produce that for 37 cents. So what you have to look at here is, again, what you are producing per hour. We've already established what the contribution per machine hour is. So that's the first thing you do. Then what you would want to look at, if you're going to outsource something, then say for instance in this case, you're going to make your own liners or you're going to buy them. So if you're making liners, then it's 40,000 in materials, 20 in labor, 15 in overhead. Then if you're going to buy the liners, so it's 250,000 units times 37 cents, 92,500 to buy it. Then if you buy it, you're not going to be able to get rid of all of your fixed overhead. So your fixed overhead, if you're making these things internally, it's 50,000. But if you outsource it, you're only saving 10,000 in fixed costs. You're still going to have 40,000. So what's relevant here is the total cost to buy it is the 92,500 that you're paying this company, and you're still going to have 40,000 in fixed costs. So it's actually, you're not saving any money by outsourcing. And that's mainly because you cannot get rid of all of your fixed costs. And that's true in many situations. You might be able to reduce it a bit, but you typically cannot get rid of all the fixed overhead. So that's something you have to consider when you're looking at these types of situations. The final decision that we're looking at here is sell as is or process further. If we were to take this particular example, we're looking at olive oil. So if we were to look at the revenue from selling plain olive oil, it's 50,000 liters at $5 a liter. Or if we were to process it further, so then it would cost us $7 a liter, so it would be 350,000. And then you have some additional costs to convert that 50,000 liters into the gourmet dipping oil. So that's another 75 cents a liter, 37,500. So the extra revenue you would get from processing further is $312,500 versus 250,000. So processing further, there is a net benefit. So you're only looking at the revenue from selling as is compared to the revenue that you would generate from processing further. And the final issue that you run into is transfer pricing. So if you're transferring your product or service from one division in an organization to another division of the same organization. So when you're talking about transfer pricing is what cost should a product or service be sold from Division A when it transfers to Division B, because this affects the profitability of the selling division, and also certainly of the purchasing division. So you have to look at, does the selling department have excess capacity to supply what's needed? Will the transfer price be high enough to cover the incremental cost? And will the transfer price be low enough for the purchasing department to achieve their target profit goals? So these are all factors you have to consider when you're making a transfer pricing decision. And that concludes this chapter.